Today I would like to analyze Crocs, one of the largest footwear companies in the world and one of the best performing stocks as well. In the last 5 years we are up around 357%, but if we take a look at the 1 year chart we can see we are down close to 30%. So we're going to take a look at the financials to find out if it's a good buy right now. The first one we can recognize is a market cap of $6.15 billion US. This makes Crocs the 8th largest footwear company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. You want to invest in a growing business and not a declining business. So in 2020, the revenue was around $1.38 billion US. This was a 12% increase from 2019, so a good growth. In 2021, we saw the incredible growth around 66%. In 2022, we saw again the incredible growth around 53%. Then in 2023, we saw the good growth around 11%. And then in 2024, we saw the decent growth around 3.53%. So overall, we can see in the last 5 years, we saw the very good growth in the revenue. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around $224 million US. This was an incredible growth around 321% from 2019. Then in 2021, we saw the incredible growth again around 127%. Then in 2022, we saw the decline around 2.4%. What the reason for that is the higher capital expenditures. We can see here it did grow around $50 million US. And we can see the operating cash flow did actually grow around 6.3%. Then in 2023, the free cash flow did grow around 63%. This is also very good. And then in 2024, we saw the good growth around 13%. So overall, in the last 5 years, I think we saw the very good free cash flow growth, and it's a check here. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. So this is around $0.92 billion US. Then we're going to divide it with the current market cap, 6.15 billion. So then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 15%. So this is an incredible high free cash flow yield actually, and it's an indication for undervaluation. But we should also make some assumptions about the free cash flow in the future. If we ask ChatGPT, we can see here in 2027, the free cash flow could be around $750 million US. So let's assume this number, then we can calculate it for 2027, 0.75 billion. We're going to divide it with the current market cap, 6.15 billion. So then we would get the free cash flow yield for 2027 with our free cash flow assumptions. So now we would be around 12.20%. And again, this is an incredible high free cash flow yield, and I also think this is an indication for undervaluation right now. The next thing we're looking for is a debt to free cash flow ratio under 5. This means a company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take the long-term debt. This is around $1.35 billion US. We're going to divide it with the current free cash flow around 0.92. So then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get would be around 1.46. And that's a great number. So it would take around 1 year and 6 months to pay back the debt with the free cash flow. So the check here. We can also take a look at the cash on hand, how much money this company has in the bank. So we can see here around $180 million US. This is also a good amount. So overall, I think this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So first you're going to calculate the enterprise valuation. This is the current market cap, 6.15 billion. We're gonna add the debt, 1.35 billion. We're gonna take minus the cash. We can see here 0.18 billion. So then we're gonna get the enterprise valuation, how much the whole company is worth. So the number we're gonna get would be around 7.32 billion. Now we're gonna divide this number with the free cash flow that we had. This is around 0.92. So then we're gonna get the ratios that we're looking for. This would be around 7.93. So that's incredibly low. So this is a very high indication for undervaluation. We like to see that. It's a check here. We can also calculate this number for 2027. So the free cash flow would be there around 0.75 billion. Then we're gonna get a different number. So the number we're gonna get would be around 9.76. And this is still a great number. So I think with this matrix, this company does look incredibly undervalued right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look and we can see here repurchase of common stocks. And yes, this company buys back a lot of their shares. In 2021, it was around $1 billion US. And this is something we like to see because I also think this company can afford it. They have a good balance sheet. So it's a check here. Can Crocs stocks be a good buy right now? So let's start with a positive. So we had a great revenue growth in the last 5 years. We also had a great free cash flow growth as well. This is something we really like to see. The balance sheet is also looking good. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 15% is incredibly high. So this is an indication for undervaluation. And also with our free cash flow assumptions for 2027, the free cash flow yield would be around 12.2%, which is again an indication that this company could be undervalued. Our enterprise valuation to free cash flow ratio around 7.96 is also looking very good, so we want to see that number under 25. So again, it's an indication that this company could be undervalued. With our free cash flow assumptions for 2027, this number would be around 9.76, which again could be an indication that this company is still undervalued. So what I don't really like about this company obviously is a fashion hype. So we don't know how much this company can sell in the future. The hype can go and come. So this is something uncertain about this company, but overall this company looks undervalued to me. If you found this video helpful, don't forget to like and comment and subscribe for more content.